Hello and welcome to Chapter 12, Practice Problem, preparing for the end of chapter quiz. We have here allocating partnership income, and again we're going to start with our highlighter. We were talking about Kara Reese, Tammy Bax, and Joe Thomas, who invested $80,000, $112,000, $128,000 respectively. So we've got Reese is at $80,000, Bax is at $112,000, sorry, and Thomas is at $128,000. Okay, so these are their capital balances, what they have invested in their partnership. And then during the first calendar year, the firm earned $249,000. That, by the way, what is earned, this is net income. Okay, so you need to be aware that when they say this is what they earned, they're talking about, quite literally, net income. Alrighty, required, prepare the entry to close the firm's income summary account as of December 31st to allocate $249,000 between the partners based on these three different assumptions. Okay, these are not accumulative, they're just a separate assumption. Every time we look at this as if we erase the board and start it all over again with a new assumption. So what I do is I set up this. I got the journal entry, I debit income summary, and I dump it into the respective capital accounts for Reese, Bax, and Thomas. I've abbreviated them by giving just the first letter of their last name, and I will do a journal entry debit credit for assumption number 1, and I'll do a journal entry debit credit for assumption number 2. Now I'll do a debit credit journal entry for assumption number 3. I'm just doing this because that way I can just kind of consolidate this into one thing. You don't have to write income summary, capital R, capital B, capital T 3 times. Well, you will, but I won't. Okay? And I'm the professor, so I get to take liberty of that. Alright? Fair enough. Let's take a look at the first assumption. The partners have no agreement in the method of sharing income or loss. Okay? So they don't have an agreement. They probably just got together and said, hey, let's have a partnership. Wouldn't this be fun? Yay, it's going to be great. It's going to be like a PJ party or something. Yeah, you're going to stay up all night and watch movies and tell scary ghost stories and eat lots of junk food, and it'll be great. Okay, so if they didn't have anything in place and they're still trying to figure out how do they divide up $249,000 of net income, then since there's no agreement in place, they're going to simply divide this between the three of them equally. So divide this by 3, and it's going to be $83,000 straight across between all three of them. So I will do a debit to income summary for $249,000 because it's sitting in there right now as a credit, and I need to get it out of there. If you recall this from chapter 4 of Accounting 111, this is where I'm closing out my books. Okay, so income summary had a credit balance originally, and now I'm going to debit that to clean out the income summary and dump it into the capital account for each of my partners, and it's going to be split out equally by $83,000 each. So there you go. Split out equally between the three capital accounts. Okay? That was pretty straightforward. Under number 2, situation number 2, it says here we're going to split out according to the ratio of their beginning capital investment. Now the beginning capital investments are right up here. That's why I highlighted it so I can find it pretty easily. 80,000, 112, and 128. So I got down here already set up the beginning capital balances for Reese, Bax, and Thomas. And so I'm going to wind up figuring out what do they wind up coming out to. What's the proportion of each of these? Here's how you do it. You have to take 80,000 divided by the total of all of this, and then the 112 divided by the total of all of this, and 128 divided by the total of all of this to figure out what percentage it is of the total. Alright, so 80,000 plus 112,000 plus 128,000 is going to be equal to 320,000. So now I'm going to take the 80,000 and divide that by 320,000 because I'm looking at what proportion this is of the total of all three capital accounts. So I take 80,000, I'm going to divide that by 320,000, and that gives me 25%, or 0.25. So this is 1/4 of 830 or 320,000. Okay, and that makes sense. 4 times 80 is going to be 32, or 4 times 8 is 32. Alrighty, let's do the next one. Bax is at 112,000. We're going to divide that by the total of all capital accounts, so 320,000 is 35%, 0.35. And then Thomas is at 128,000. And we're going to divide that by 320,000. And that gives us 40%, 0.40. Okay. Now if I did this correctly, all of this should equal 100%. 1.00. And 25 plus 35 plus 40 does indeed equal 1. Or 100%. Okay. Then I'm going to take these percentages and I'm going to multiply each of these percentages by the 249,000 net income, because this is what I'm splitting up, net income. Okay. So I will start with a total of 249,000, and I'm going to find out what the proportion of each of these guys, okay, to the total of 249. That's how I'm going to split up my net income. So 249,000 times 0.25 is 62,250. 0.35 times 249,000 is 87,150. 0.4 times 249,000 is going to be 99,600. And for good measure, you might just want to make sure these numbers do indeed equal 249. Make sure your calculation was good. So 62,250 plus 87,150 plus 99,600 is 249,000. Good. Alright, we did good. So my second entry, I'm going to debit income summary 249,000. And I'm going to credit for each of the capital accounts with these numbers I just calculated here, the proportions. So 62,250, whoopsie, get this right, and 87,150, and 99,600. Okay, that's my journal entry for situation number 2. Okay, easy enough. Alright, now number 3, the partners agreed to share income and loss by providing annual salaries allowances of 66,000, 56,000, 80,000. Okay, then granting 10% interest of the partners' beginning capital investments, and then after that sharing the remainder equally. This is a 3-step process. Okay, I got to do, first of all, I need to pay them salaries, okay, of these amount. Then what's left over of the $249,000, I now have to do it according to 10% interest of their beginning capital investments. So I'm going to be looking at the beginning balance of the capital investments and doing 10% of that. And then if there's anything left over, be it either a positive amount or a negative amount, because you could wind up allocating more than what's available of the $249,000, or you could allocate less. Either way, you're going to wind up splitting it out equally. Okay, so let's take a look at that problem next.